Welcome to this video where I'll be sharing our views on the equity market. Globally, equity markets have recorded positive returns this year but have given back some of those gains more recently. For many investors, the question is whether markets are on a longer-term downward path, or will a market correction provide an opportunity to add equity exposure at better valuations? Now, pullbacks in the equity markets are common, and a period of softness after the strength of the early rally needs to be viewed in context. A 5 to 10% decline within a calendar year in the Australian equity market is not unusual. The end of the rate hiking cycle could provide a boost to equities and longer duration parts of the market. The avoidance of recession could also see a rotation into more cyclical sectors that have lagged so far. We don't think this is a time to be underweight equities in a portfolio. History shows that when the Fed stops hiking, equities generally do well. Investors, however, should still be mindful of excessive valuations in some pockets of the market. Now, the rise in a handful of names in the US equity market has raised concerns around the market concentration, something that could be very familiar to Australian investors. But this is not a phenomenon in other large developed markets such as Europe or Japan, where the weight of the top 10 companies within the index has been fairly steady over time. Beyond the US, investors could consider the emerging world outside of China, such as India and parts of Southeast Asia, where domestic growth momentum is strong and monetary policy could become supportive of growth. Japan's economy continues to strengthen, and the shift away from ultra-loose monetary policy provides a reprieve for many companies, as well as a weaker yen, which could help exporters. Overall, the valuation dispersion for a broad global equity index remains wide compared to average, and average valuations are not excessive. We believe an active approach to equities can still deliver returns even in a softer economy. Thanks for watching.